This is 8-Minute Market Structure by Texture Capital, bringing you concise expert insight for better markets. And now your host, Richard Johnson.
Hello, my name is Richard Johnson. I'm the founder and CEO of Texture Capital. We're a FINRA member and SEC registered broker-dealer specializing in digital securities. We help institutions more efficiently and directly participate in private markets by providing tools for tokenization, issuance, and secondary market liquidity. Welcome to the second episode of 8-Minute Market Structure, where I speak with industry experts and get their take on the most important market structure issues. It's a simple format. I ask the same question for every guest. If you were building a market structure from scratch and could change one thing, what would it be? It's one topic, no prep calls, just 8 minutes of concise expert insight for better markets. Today's guest is Dave Cushing. Dave spent 12 years as a senior managing director and partner at Wellington in charge of trading and market strategies globally and across multiple different asset classes for the $1.3 trillion asset manager. Prior to Wellington, Dave worked in the electronic trading team at Lehman, but he and I go further back than that to ITG, where we both worked together and where Dave was in charge of building their pioneering algos and TCA products. Dave was also an advisor to Clearpool prior to their acquisition and is currently an advisor to a great company I know in the space called Talos. So it's safe to say, Dave, you know a thing or two about market structure. So let me put the question to you. If you were building a new market structure from scratch and could change one thing, what would it be?
Thanks, Richard, and I appreciate the invitation to be with you here today. I was very intrigued by your question and by your format when I heard you first mention it. And the thing that really first sprang to mind for me was price discovery and what you might call liquidity discovery in markets, and how there's really benefit to bringing multiple participants together in a scrum, if you will, to try to make that process better as markets operate. And so, the way I would maybe try to frame this, and maybe a lot of people don't know this, maybe even among your more mature viewers, but the legacy New York Stock Exchange system, for all of its flaws, had one thing about it that was really great, which was that the market operated as a series of auctions. So specialists learn how to think fast, talk fast, make markets fast, but fundamentally at the end of the day, they were running hundreds, sometimes thousands of auctions throughout the course of the day. And that was, that's what I think allowed one of their NYSE past presidents to famously remark, "We produce the price." And so, when you fast forward to today, we obviously have the whole, in the transition from legacy to electronic markets, one of the things that basically washed away, for the most part, there are very important exceptions, but for the most part, the idea of the market, the central market, or the primary listed market, as being fundamentally auction-driven process. Mm-hmm. And so certainly some participants have tried to bring elements of that back. Notably, IEX is probably the most famous example of that with their coiled fiber that slows down the arrival of order information so that there's a more level playing field. But broadly, that concept, I think, is something that's we really sorely need to reintroduce to markets. And that becomes especially true for less liquid assets. Mm-hmm. I mean, why do we need at the microsecond level to be able to execute a stock that only trades relatively infrequently during the day? That's the extreme example, but it's true to varying degrees all the way up to the most liquid stocks.
Yeah, no, well, I couldn't agree more. In fact, it's a topic close to my heart, as what we've built at Texture is in fact a call auction ATS. So we're innovating in private markets, and part of the reason I set this podcast up is to get the viewpoints from all these experts. And we chose a call auction process because we know it's going to be a less liquid market. I think, if something's trading $200,000 a day across 6 or 7 prints, that's too much information leakage, and let's kind of concentrate that into one print in an auction, or maybe multiple prints per day. So I was on a panel recently, and somebody said that the one size fits all market structure that we have, and maybe the continuous markets work fantastically for Google and Apple and so forth, is causing investment managers to kind of keep out of the small cap stocks because the costs of trading have gone up. Is that something you experienced at Wellington?
Yeah, very much so. And we saw there's certainly, again, if you take a broader perspective, there were very significant cost declines over the span of decades through the reform of market structure. But as operators became more sophisticated in the electronic space and other certain factors such as bank regulation and things like that started to work against the availability of liquidity, you saw those costs start to turn the corner and head higher again. And that's where I think the thought process around trying to introduce, or to use your phrase, to move away from the one size fits all model, became really important.
Yeah, and you talk a little bit about how other things have evolved in the space, like you mentioned the electronic market makers, and what effect do they have on price discovery?
Yeah, I think. We could quickly digress into the whole payment for order flow and maker-taker models and all those kinds of things. But I think that it's, again, there have certainly been some benefits by automating and bringing liquidity to bear, across competing market makers within the context of the current market structure. But I also feel like there have been opportunities lost. Just take one example. Retail price improvement. It's minuscule. If you look at the reports, the amount of price improvement that's available from order flow that's routed away from the exchanges, those price improvements tend to be quantitatively pretty small. And so that would be one example where if you were running a more of an auction style market, there'd be opportunities for retail flow to get exposed to those auctions and potentially get a better price. So those would be some of the things that, that's kind of, again, you have to take a balanced view on things. And while you certainly don't want to overlook the benefits of electronic market making, I think there are also some opportunities to bring a little more benefit to other market participants through market structure.
Yeah. I think another interesting trend that we've probably both observed is that auctions aren't completely absent in today's markets. The NYSE and the NASDAQ open and close every day with an auction. And what we've seen is that the market on close on the New York Stock Exchange has increased from something like, I think, 3% market share 20 years ago to maybe 7% 6 years ago to now I think it's about 14%. Is that right?
Sounds about right. Yep.
Yeah. And what do you think the reason for that is?
Yeah, I think a lot of it has to do with benchmarking and index fund in particular, or passive management in particular. And so, but there's also been this concentration of liquidity. How to say this? People are waiting until later in the day to really to put themselves out there and commit to a price. And you've seen the volume smile became much more skewed over time towards the close. Trading in the first few hours of the day has almost become a fool's errand, because you're not going to have access to as much liquidity. The spreads are going to be wider. There's a higher chance that you're going to look bad, say, relative to the closing price, and so on. And so it just naturally, it becomes a little bit self-fulfilling in the sense that liquidity does beget liquidity. And if it starts to shift for whatever set of reasons towards the end of the day, that trend is more likely to continue up to a point than it is to revert. And not to oversell this idea, but it might be one more reason why it would make sense to intersperse other auction points throughout the day, or at least make that mechanism available for trades earlier in the day.
That's a great idea, and it's a great concept. I think what we have is you've got 14% of daily volume going on from one trade. There's certainty. You can be sure that you're getting as many buyers and sellers together as possible, which makes the markets more efficient. Dave, we could go on, but then it wouldn't be called 8-minute market structure. So thank you very much for your time and thank you for joining us, and look forward to speaking with everyone next week.
Thanks, Richard. Really appreciate the opportunity to chat today.
Thanks a lot.
This has been 8-Minute Market Structure. Be sure to follow Texture Capital on LinkedIn, where we will release a new episode every week. You can also find us on Twitter at texture_capital and on the web at texture.capital. The foregoing discussion is for information purposes only and does not constitute a solicitation to buy or sell securities. Private securities offerings are not registered with the SEC and are considered highly speculative. An investment in private securities may result in the loss of your entire capital contribution. Blockchain is a new technology and unproven in financial markets. There is no guarantee that tokenization will enable any secondary market liquidity in the future, and your investment may remain illiquid.